Hello students, welcome to my class. This is Professor Vicente Saga and this is part 3 of chapter 8 presentation. Chapter 8 receivables. Now let's take a look at the objective 3. Here we are going to, in the previous session, we talked about 2 ways of measuring bad debt expense or uncollectible accounts based on extending credit to customers. We said there are 2 methods of doing so. Number 1, the direct write-off method and the allowance method. So we talked about the direct write-off method in the previous part of this presentation. Here we are going to talk about the second method, and the second method is generally accepted accounting principle. The second method is the OK method. The previous method is not okay, but we still talk about it because there are some extenuating circumstances whereby direct write-off method is acceptable. Now, having said that, this method, the allowance method, is more complicated than the previous method. There are 3 parts to it. Number 1, in other words, there are 3 types of allowance method. Number 1, percent of sales. Number 2, percent of receivables. And number 3, aging of receivables. Either way, the spirit of these 3 methods is the same. Here we are making provision for X amount of dollars that might not be collected based on the credit sales that we extended for each year. So this is purely an estimate. As you know, accounting is not an exact science like physics or mathematics. 2 plus 2 will always be 4. In accounting, there are some situations whereby it is perfectly okay for us to estimate. Now, having said that, let's take a look at how we record uncollectible accounts using the allowance method. This method is GAAP. It's generally accepted accounting principle because it makes provision for the matching principle, unlike the previous method that violates the matching principle by not recognizing bad debt expense in some years. So, like I said, we come up with an estimate of X amount of dollars that might not be collected in the future, and we use that as a basis in recognizing or recording bad debt expense. Now, again, like we said, it is an estimate, and it is perfectly okay in accounting to come up with some estimate in some situation. So at the end of every period, we will always have bad debt expense, even though we are not aware which customer is going to pay or which customer is not going to pay. Now, so we recognize that expense. So we debit expense account and we credit an account called allowance for bad debt. It is very important for you to know this. For the allowance method, we said there are 3 types of allowance method. It doesn't matter which of the allowance method we are using. The part of the matter is the account that we debit is the same, which is bad debt expense, that is the expense, and we credit allowance for uncollectible account or allowance for bad debt. Okay? Now, how we calculate the amount that we use for that adjustment is the difference between the 3, or one of the differences between the 3 methods. But either way, the account that is debited and the account that is credited is the same. I also want you to know here that this account, allowance for bad debt, is considered as a contra account. Remember in the previous chapter we said that a contra account is an account that offsets another account. In this case, the allowance for bad debt is a contra account to accounts receivable. We are going to demonstrate that in a few minutes. So, now, the last thing we need to know here is when we know for a fact that an account will not be collected, we write off that account against the allowance for bad debt, because the allowance for bad debt is more or less like a savings account that you set aside for emergency or for a rainy day. And when it actually happens, we write off the accounts receivable against that account. So let's take a look at how this works. Here is just an example to demonstrate the allowance method before we get into the 3 methods specifically. So in this case, of the $4,400 in accounts receivable, the company figured out that about $80 might not be collected. All right. So it is just an estimate. So here's what we do. We debit bad debt expense for $80 like we discussed, and we credit allowance for bad debt. Again, it doesn't matter which method you are using, the account that is debited and the account that is credited, the same. So you need to put that in your memory. So now moving forward, take a look at, this is how we record the provision, or how we record bad debt expense, like we just demonstrated. Now, after recording, ultimately we report the information in the financial statement. Of course, in this case, one of the financial statements that will be affected with the balance sheet. Of course, the bad debt expense will be reported in the income statement, and the allowance for bad debts will be reported in the balance sheet. So let's take a look at how that works. See, accounts receivable is $4,400. Allowance for bad debt is $80. The normal balance of accounts receivable is debit. The normal balance for allowance for bad debt is credit. Why? Because the allowance for bad debt is a contra account to accounts receivable. It offsets accounts receivable. So for reporting purposes, so we have accounts receivable for the $400 and less allowance for bad debt $80. So the $43.20 is the net realizable value of accounts receivable. So what we are saying here to the whole world, whomever is looking at the balance sheet or reading the balance sheet, we are saying here we extended $4,400 worth of credit to customers. However, we make a provision for $80 that might not be collected. It's an estimate. It's better than nothing, because we realize that it is a part of life that some customers will not pay. So the difference of $43.20 is what we call net realizable value. In other words, that is the net realizable accounts receivable. That is what we anticipate to receive in the future. Now, moving along, by the time we discover that a particular account would not be collected, in this case, take a look at what will happen. We now find out that one of our customers filed for bankruptcy. The customer actually called us and said, listen, I just filed for bankruptcy. I'm not interested in going back to look for a job. It is not likely that I'm going to pay you. You check out the situation and you know that it's true. So guess what happened? Then you need to write off the customer's account. How do you write off the customer's account? Originally it was debited. You need to credit the customer's account. In this case, 25. Now, what do you debit? Watch this on your exam. You are not debiting bad debt expense now, because bad debt expense was recognized at the end of the accounting period, be it monthly, quarterly, or yearly, when you make your adjustment. So you already made provision for bad debt expense. So during the following accounting period, when it comes to your attention that a particular customer will not pay, you don't debit bad debt expense again. Rather, you debit allowance for bad debt. Because the allowance for bad debt is a provision, is what you set aside for account that might not be collected in the future. So when you are writing off an account, you write it off against allowance for bad debts. Now, let's assume that miraculously the customer call you back in 6 months and say, you know what, my grandfather died and I inherited $500,000. I'm interested in paying you $25. Of course, you gladly receive the $25. So what do? You reverse the entry that you did before. Now you debit accounts receivable to establish accounts receivable to bring it back to life, and you credit allowance for bad debt. Then you make the second journal entry and gladly receive the cash and debit cash for 25 and credit accounts receivable for 25. Now accounts receivable is 0. Now, here are the 3 methods like we discussed. Number 1 is percent of sales, number 2 is percent of receivables, and number 3 is aging of receivables. Now let's take a look at the percent of sales. Percent of sales is the easiest of the 3 methods. Take a look at how it works. Very simple. Look at the formula. Your net credit sales multiplied by X percentage that you think might not be collected. That's simple. So if at the end of the year you extended $500,000 net credit sales to customers, and you say, based on our history, or based on the industry's experience, or based on our experience, or based on the experience of the average company in our industry, we figured out that 1% of the $500,000 will not be collected. So we multiply 1% by $500,000, and that gives us $5,000. So we use that $5,000 to make the journal entry. Again, we debit bad debt expense for the $5,000, and we credit allowance for bad debt for $5,000. So this is very simple, straightforward. All right. So take a look at the next method, which is percent of receivable method, and the aging. That's the third one. Those two are more complicated, and those two are very similar. So take a look at what we are doing here. The first thing we need to do here is to establish a target balance. What do we mean by target balance? A target balance is the desired balance that we need in the allowance for bad debt. Remember, allowance for bad debt has a normal credit balance. It is a contra account to accounts receivable. So the question is, how much do we need in that account? That is what we mean by the target balance or the desired balance of that account. So how do we calculate it? We multiply the ending accounts receivable by the percentage of bad debt, whatever that percent is, and that will give us our target balance of allowance for bad debt. Now take a look at the second step. We now take a look at what the existing credit balance of allowance for bad debt is. So if we do the first step and we come up with 50, and that is our desired balance in that account, and we already have 20 in that account, $20 credit, and we desire to have 50, the difference between 50 and 20 is 30, and that 30 is what we need for the accounting period adjustment. So we are going to debit bad debt expense for 30, and we are going to credit allowance for bad debt for 30. Now, let's take a look at the third method, which is aging of receivable method. The aging of receivable method works like the percentage of accounts receivable. Take a look at what happened. The only difference is how we work at the amount. The target balance again. Target balance of what? Allowance for bad debt. So we do the aging, and we group all the accounts receivable into different categories in terms of aging it. We are going to demonstrate that in the next session, and multiply that by the related expense or percentage. That gives us our desired balance in the allowance for bad debt, or the target balance. Then the second step is we go ahead and take into consideration the credit balance, or the debit balance for that matter sometimes, of the allowance for bad debt, and do the math and come up with the amount that we need to make the adjustment. So that is the conclusion of part 3 of this presentation, and we will illustrate this further in part 4.